because interest rates are not going down anytime soon, in fact, there might be a chance of them going up from here, I think it's important to talk about some options you have as home buyers to still get a really good deal and have a payment that you're comfortable with while we're waiting out the storm of the interest rate environment that we are in. So today I'm going to be talking all about rate buy downs and why I think that they are a great product for people who are a little bit scared of like the 7% interest rates that are currently on the market, but still want to get into a home at a decent amount. That is what we're going to be talking about today. But as a recap, or maybe if you didn't see the last video, my name is Tiffany. I'm a lender here in Las Vegas, Nevada. I've been lending for over 5 years and I've helped over 200 families with their home buying needs and would love to help you with yours. So if that is something that you're interested in working together on, I'm going to leave all of my information in the description below so you guys are able to connect with me and we can chat about your home buying dreams and see how we can make those a reality. That is everything from me. Let's get in to the video. So first, let's talk about the different types of rate buy downs, because a lot of times what you'll see realtors and everyone talk about is temporary rate buy downs, which I'm not gonna lie, that's where all the interest is. That's where all my clients are talking about. But there is still a permanent option, and I actually have people who are interested both ways. I do see way more interest in the temporary one because you have so much more savings on the front end, but there is that option too to just buy down that interest rate for the entire life of the loan. That way you don't have to worry about, if rates are up or down in the next few years. So that is one option, is a permanent rate buy down. I will say your money doesn't get you as far as upfront savings, but it gets you lifetime savings if you're someone who just wants to sign a loan doc one time, you don't want to refinance, and you want to get the best deal possible and not have to worry about what interest rates are going to do from the future here. So that is an option for some people who just like stability. But the one that I'm going to be focusing on a lot during today's video is actually what's called a temporary buy down. This is for a set amount of time. Usually you'll see this in increments of years. The most popular one that I've seen is what's called a 2-1 buy down. So it's going to be affecting you for 2 years. For the first year, you get 2 points off of the interest rate. Year 2, you get 1 point off of the interest rate, so that in year 3, you go back to whatever the standard market rate was at the time that you signed all your loan docs, assuming you haven't refinanced by then. That is the most popular one. They also have a 3-2-1 where you have a lower than expected interest rate for the first 3 years of the loan, and then a 1-0 buy down where you have a lower interest rate by 1% for the first year of the loan. It really just depends on how much credit you can get from the seller and how much the payment makes a difference from you as far as what term you end up going for. I will say the most popular one that I've seen is 2-1. I would think it would be the 3-2-1, but I feel like people are skeptical with it being so much lower and getting used to that payment for the first year. That is how a temporary buy down is structured. Now, how it works is the seller or one of the agents has to contribute funds to your closing in order to do a buy down program. That difference in payment that you're seeing for the first few years, whether it's the 3 years, the 2 years, the 1 year, that is actually going to be sitting as credit in the title company's escrow account, and they're actually going to be helping you make that payment for that set amount of time. So that's why you have to pretty much let everyone know that that's what you're wanting to do, because that credit cannot come from you. It has to come from someone outside of you. So that could be either one of your agents, the buyer's agent, the seller's agent, or even the seller themselves. They can help you pay for that rate buy down, but that's not something that you can buy yourself. What happens is whatever the difference in payment is, let's just say, I'm gonna use rough numbers. These are not mathematically correct by any means, but it just gives us a good idea of what to expect in this process with really easy numbers. So let's just say at 7%, your monthly payment is $2,000. And if you're doing a temporary buy down, let's just say you're doing a 2-1. And for the first year, it brings your payment down to $1,500. And then the next year, it brings your payment to $1,750. So basically that difference in payment, that $500 the first year, a month in payment, and then the next year it's $250 a month. Basically what happens is title collects the money needed from the seller in the form of credits. So, 500 times 12 and then 250 times 12, put that together. That's going to be sitting at the title account. So each time you make your payment each month, basically part of it, title is chipping in to help you offset that payment. So that's why this is temporary. Title's not going to do that for the rest of your loan. They already have to worry about your escrow account. That's not something that's going to be a longevity play, but that helps you at least in the front run have a payment that's much lower than standard. So again, this is sitting with title. They're the ones helping you make that payment for the first few years, and the credit has to come from someone outside of you in the transaction. So that's pretty much how a temporary buy down, like how it works in the gist of the program. You know, you making your payment each month. How is that happening? Who is going to be helping you make this payment, basically? Because it's not just like, hey, you get this payment now and it's like you're qualifying for it. You're still technically qualifying at whatever the market rate is at that time. It's just now you're getting assistance and making that payment in the form of these buy down credits. Now, who is a temporary buy down good for? I'm gonna say this as simply as I can. It's for anyone who wants a lower payment for a short amount of time. No one knows what's gonna happen with interest rates, and there's a lot of speculation if they're gonna go down, they're gonna go up, what's gonna happen. But I think a lot of people are optimistic that interest rates should go down within the next few years, especially let's just say if you bought a house this year and you think within 2 years interest rates are going to go much lower. That is someone that would be a good candidate for a temporary buy down. Now, what I will say is that there is some risk involved here. So it really just depends on your tolerance, because let's just say you did this product back in 2023 and you did the 2-year buy down. You probably did that hoping that interest rates would be lower by this time of the loan coming due, and they haven't. So there is a risk there, especially with the interest rate environment that we're in and where I think rates are heading. I think that there's a little bit of risk there. Now, is it 2 years worth of risk? I'm not sure, but I definitely think that if I were talking to a client, a 1-year buy down is not even worth it. I would rather use those funds to just permanently buy down that interest rate. If you could do a 2-1 buy down, I think that that would make more sense, although I think it's going to take the whole 2 years for us to see interest rates get down to that level of 2 points lower than where we're currently at, like that 5%, maybe low 6% rate. I do think it's going to take us probably about 2 years to get there. But if you are okay with taking that risk in the short run, then I think that that would be a good product for you, especially if you do the 3. Getting the credit for the 3 is going to be really tough. Just in my experience, I see my clients are able to get credit for the 2, and they're usually not really like arguing with that as far as sellers' credits go. But usually if you try to push it to the 3, that's where I start to see some pushback from all the parties involved to give the credit that is needed for that. Now, I will say, I think that this is a really great product if you are someone who wants to wait out this interest rate environment that we're in. Because I know that rates are not sustainable at this rate. I don't think we're changing anytime in the nearby future, but I do think that these rates are a little out of reach for most people. But I also think too, home buying is going to be out of reach for most people in the next few years. So if you can buy a home now, I think it makes sense to do whatever you can to make that payment easier for you in the short run. That way you at least get into a home, you start building equity, you start having an appreciating asset, and you will figure out the payment situation as you can. I don't think that that's a bad play, but it's a very risky play. But I'm risk tolerant. So if that's not you and you're not risk tolerant, a temporary buy down may not be the move for you. Not gonna lie. But if you have a little bit of a tolerance for risk and you believe that interest rates are gonna go down in the time that you have set for the 2-1, 3-1 buy down, then I think it's a good product for you. But if you're not risk tolerant and you're scared that interest rates are not going to fully go down, I probably would not recommend that product for you, truthfully. Final thoughts. I'm a fan of this product. I've seen it help so many people get into homes and have an affordable payment for even the beginning part of their loan term. I think that especially if you are just a normal average person who's going from maybe renting to owning, like this is a great opportunity for you to have that lower payment, at least in the short run. So for the first year, you can maybe focus on getting the place furnished or making upgrades to the property. Maybe you want to add a backyard, maybe you want to make some home improvements, or maybe you just want to build up a savings nest so that way if something goes wrong with the house, you have savings to fall back on. So I personally really love this product, especially because of that first year of home ownership. I know people don't really anticipate how much it's going to cost you to furnish a house. Now you're moving from an apartment to a home, and now your bills are completely different. Like your energy bill is different, your gas bill is different, your water bill is different. So I think that that first year can come as a shock to people in general when it comes to moving, whether you were doing a buy down or not. So I personally really love this product because I think it gives people flexibility, especially as they enter into the home, to have more flexibility with payment. Again, it all depends on your tolerance level, and if you're okay with, hey, this is only temporary, this isn't forever, I can't get used to this payment. That I think is up to everyone, but I hope you guys enjoyed this video. Please make sure to give a big thumbs up if you haven't already, and I will see you guys in the next video. Bye!